Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
Well, hey there, everybody. Nate Miller with Retirement Rescue Radio here to bring another episode. And I want to say this is going to be timely because the title of today is going to be 10 things that you should know about bear markets. And I'm going to take the majority of this from an article from the Hartford Funds. And this, I believe, is important because, well, we have entered into bear territory. As of the recording of this, we actually have entered bear territory and have slightly gone back out of bear territory. But, you know, this is the time when a lot of people are going to kind of be a little worried about what's going on. So I want to help give a little bit of perspective and possibly a little bit of reassurance with what's going on here. Now, when I say reassurance, I am not going to be someone who is so Pollyanna that I'm going to get on here and tell you that there's absolutely no recession possible coming, right? That's not the case. I'm also not going to be doom and gloom and say that I don't think that this quote recession that we might actually already be in, just not a technical recession yet, as it's defined by 2 quarters of negative GDP decline. But I would say that it's going to be another one, right? It's not going to be the worst we've ever seen, but it is going to be another one. And so I just kind of want to give some history around bear markets to help give perspective and maybe a little bit more peace of mind with what's going on. Because again, this is not the first time that a recession has happened. And recession, bear market, not the first time a bear market has happened. Well, it's also not the first time a recession has happened either. So I guess that's still true. But I want to give you some ammo. I want to help arm you guys with knowledge, because the more knowledge we have about something, the less afraid of it we will be. I think about that even starting a business, right? When I launched out on my own, a lot of people look at that as very, very risky, but risk is always lowered with knowledge. And so I felt like I had a lot of knowledge about what I was going into, and that helped lower that risk a lot. So as me, from my standpoint, I saw that as a much less of a risk than what some other people may have who may not have had any experience in that industry or in starting businesses. So that being said, let's go ahead and get into the 10 things to really keep in mind when it comes to a bear market. First off, we need to define what a bear market really is. I've had several podcasts where I go into the differences between bear markets, pullbacks, corrections. They all have actual technical definition. They're not just random terms that people throw out every time the stock market goes down. So a bear market is 20%. That's it. Market cycles are measured from peak to trough. And so a stock index officially reaches bear territory when the closing price drops at least 20% from its most recent high, whereas a correction is just a drop of 10 to 19%, or technically 19.99, right? And so then a pullback is a drop of 5 to 9% from the most recent high. So pullback 5 to 9. That happens a lot. Correction 10 to 19 also happens pretty frequently. And then the bear market is 20%. A new bull market, however, will then begin when the closing price gains 20% from its low. So the peak that we had in right around January, we have been over 20% decline from there. So we have officially entered a bear market. Now, when the market goes back up 20% from that bottom, we will be in a bull market again. So now to give you guys a little bit of averages and perspective. So the second thing about bull markets is that the average decline in stocks is about 36%. And so that can be a little painful, right? That's over a third of our portfolio that might go down. And it's really kind of painful to see a third of our portfolio just go poof, right? But by contrast, stocks will gain an average of 114% during that bull market. So way outweighs what you might have lost during the bear market. Also, understand that bear markets actually are normal. There have been 26 bear markets in the S&P 500 index since 1928. However, there's also been 27 bull markets, and stocks have risen significantly over the long term. So also, bear markets tend to be pretty short-lived. The average length of a bear market is 289 days, or roughly 9.5 months, or 9.6 months technically, right? And so that's significantly shorter than the average length of a bull market, which is 991 days, or 2.7 years. So really, every 3.6 years, that's it. That is the long-term average of the frequency of bear markets. All right. So what's interesting about that, basically every 3.6 years, well, we kind of just got through, the last big bear market that we all remember was the painful one in 2008. But then we really didn't have a bear market. Maybe we count the coronavirus disruption, but I mean, it really just bounced. It was like down 36 and then right up within just a few months. And so that was not the norm when it comes to bull markets, or even bear markets, excuse me. And so, but that time frame from 2009 all the way to 2020, when the coronavirus happened, that was there were no technically bear markets at all during that more than a decade long time period. And so I feel like a lot of us kind of got, not lazy is the right word, but we really didn't realize how often it happens. Maybe we got complacent a little bit, and realizing that, we should come to expect these actually a lot more often than what they've been happening. And so every 3.6 years, that is the long-term average frequency between bear markets. And many consider bull market that ended in 2020 to be the longest on record, but that all depends on what index you kind of use and where you draw the line of, what percentage down it took. Because some people think that December of 87 until the dot-com crash in March of 2000 was technically the longest. They said that there was a drop of about 19.9% in 1990, which nearly derailed that, but also depends on which index that you're looking at, really, because some of them did go into bear territory. So anyway, that being said, number 6 would be bear markets have also been less frequent since World War II. So remember, I said the long-term average was about every 3.6 years, right? Well, between 1928 and 1945, there were 12 bear markets, or one about every 1.4 years in that case. Since 1945, there have been 14, one about every 5.4 years. And so now we're looking at, since 1945, the average is actually not every, 3.6 years, it's 5.4 years. And so that's going to be, what is that, 60, what's 0.4 of 12, right? So anyway, you're looking at over 60 months, 5 years of bull markets since World War II. That's kind of been the average now, guys. And so we can expect a bear market, and then 5 years later, a bull market, and then 5 years later, a bear, 5 years, and then that, and only 289 days, then we got another bull. So that's really kind of how we can expect, guys. And here's what's interesting. So for those of everyone that are trying to, quote, time the market, which I want to define timing the market right here. So the way I look at timing the market is you're either all in the market or you're all out of the market. That's it. It's like you're like, I don't like where things are going, so I'm moving everything to cash. And then all of a sudden you're like, well, I think it's turning around now, so I'm going to put all my cash back into the market. That's timing the market. Strategic asset allocation or tactical asset allocation be a little bit different. That's where we don't get out of the market, but we might tweak the portfolios or tweak the investments a little bit to where we think there might be a little bit more growth. Like, so right now, tech stocks have been absolutely hammered. Does that mean tech stocks are absolutely horrible? No, that actually might mean that tech stocks are now poised for the highest rebound or the highest amount of gain during this next bull market, because they've suffered some of the heaviest losses. So again, they pretty much will have some of the largest rebounds. Now, that's just my own opinion. That's not necessarily a fact. I mean, there's strong evidence that could be the case, but that's kind of just to give you an example is really what that was. So that's it. And because of that, the whole timing the market thing, give you an idea here of when you hear someone say, ride it out, right? It's not just because they don't have any other strategy up their sleeve. It's because they know, they've looked at history, they've looked at all of these cycles, and they know that half of the S&P index's strongest days in the last 20 years have occurred during a bear market. And another 34% of the market's best days took place in the first 2 months of a bull market, really before it was even clear that a bull market had begun. So in other words, the best way to weather a downturn could simply be to stay invested, since it's difficult to time when the market is going to have that, when it's going to start that big recovery. And so also, a bear market doesn't necessarily indicate an economic recession. All right. There have been 26 bear markets since 1929, the big Great Depression, right? But there's only been 15 recessions during that time. 26 bear markets, only 15 recessions during that time. And bear markets often go hand in hand with a slowing economy, but a declining market doesn't necessarily mean that a recession is looming. All right. Now, that's not to say that there's not a recession on the horizon right now, because we are in a different atmosphere than what we were for some of those averages that they're taking, right? And so, don't let that make you think that I'm sitting here saying again that there's not going to be a recession. Again, to repeat, I'm not Pollyanna enough to realize or to think that there's no recession coming, but I also don't think it's going to be like a Great Depression, right? It's not going to be horrible. It's probably going to be one of the averages, knock wood or shine my crystal ball here. So now I want to another average here. Let's say, assuming we're going to go 50-year investment horizon, you can expect to live through about 14 bear markets, give or take. And so let's think about that 50 years. So, if you're 20 when you start, 70, or if you're 30 when you start, that's 80. And so, so the vast majority of your investing life, you can expect to live through 14, depending on how long you live, 14, 15, 16, maybe bear markets. So it's going to be the norm. And we should probably understand how to take advantage of that. Let me give you a couple things here before I go into number 10. So right now, if you are currently in retirement, you are probably pulling money out of your nest egg. You're not putting money in. And so you're like, well, shoot, I'm not really dollar cost averaging in anymore. I'm not buying more shares at this lower amount. I'm pulling money out. So, I'm a little bit gun shy of pulling more out or doing anything during this, except for maybe, the knee-jerk reaction of going to cash or getting out of the market or something like that, right? But if you have a lot of qualified money, and maybe Roth conversions have been part of your discussions with your financial advisor, I know they happen to be with a lot of our clients, well, then now could be a great time to actually do some of those Roth conversions. Because if you think about it now, let's picture a slinky. Like, I've got a slinky in my hand. I'm sorry if you're listening to this on the podcast without the visual representation, obviously, then you're at a little bit of a disadvantage, but maybe not so much, because I actually don't have a slinky in my hand. I'm just miming the slinky. So let's pretend I got a slinky in my hand, right? And now what we're going to do is, here is where the market was. It was up here like this at the beginning of January, right? Well, then imagine that slinky gets compressed all the way down to where it's just sitting there. It's all the way down. Well, that's where it's at now. The market has gone down. It has been compressed. Those share prices are now lower. So now let's say we go ahead and convert some of those dollars over to Roth. And then now all of the growth, when that slinky gets back up, right? When the springs back up, now all of that growth is going to be tax-free. So this is a great time to do some Roth conversions if that has been part of your guys' tax plan, so that could be an easy way to take advantage of this bear market. So there's still moves that can be made, and smart moves that can be made during recessions to take advantage of certain situations, that being one of them. And so there's a couple things. Now, on to number 10. Obviously, bear markets can be painful, right? It's no fun going through it. I get that, right? It's like when you're fighting, being punched is no fun when it happens. But if you end up winning the fight, well, that makes it all worth it. I mean, it still might hurt, but you win, right? But while you're going through it, it's not fun. But overall, guys, markets are positive the majority of the time. Of the last 92 years of market history, bear markets have comprised only about 20.6 of those years. So of 92 years, 20.6 of them have been during bear markets. So put another way, stocks have been positive on the rise, basically, 78% of the time. So if we have 78% of the time where the market is positive, most bear markets only last 289 days. And on average, the drop is about 36%, but on average, the stocks gain 114% during the bull markets. Guess what? That means we're going to be positive. That means we just have to wait this out. We don't want to make those knee-jerk reactions. And because a lot of times, according to a lot of behavioral science or behavioral finance, economic finance, whatever you want to call it, economic behavioral finance, all those terms, people tend to make not the most intelligent decisions about money and finance when they let their emotions take over. And so what we want to do is make sure, once again, we keep that level head. We stay plugged into good level-headed market advice. We don't want to be on the TV with the guys that are like, buy this, sell that, sell this, buy this. It's like, that's, by the time they're doing that, it's probably too late with those investments anyway. And so we want to, and that's not how we invest for people's retirements anyway. We're not looking for the next greatest, hottest stock pick or telling everybody to put their money in Bitcoin and ride that roller coaster, right? It's like, we're looking for a lot more conservative and predictability with their portfolios, because the way I've always looked at it is, I would rather be a boring investor so that you can have an exciting retirement, not the other way around. Because a lot of times when the market is exciting, it's usually exciting in the wrong way, right? If the market does 5%, 10% in a year, that's not really exciting. That's kind of expected, right? If the market does 30% in a year, yeah, that's exciting, but that doesn't happen too often. But when the market's down 15%, down 20%, down 30%, yeah, that's really exciting, but it's exciting in the wrong way. And so that's why I say it. I would rather be a boring investor so that you can have an exciting retirement, not an exciting investor so that you have a boring retirement. And so that's it. I just want to give that bit of reassurance to people that so far, I can say that any of the plans that I've looked at have not been blown up by what's going on right now. And so I would say that I haven't seen any retirements. That doesn't mean that they don't exist, that are out there, right? I haven't seen any retirements right now of any of my clients that have been blown up because of this. Because when we do our planning, we expect things like this to happen. We just don't know the exact timing of when they're going to happen, right? But we have to make sure that we have stuff set up beforehand. That's why we call it planning. That is literally the definition of planning, is taking care of something before it actually happens. You are planning for something that has yet to happen, but we know it does. So that's why a lot of our products that we use are principal protected that still have good growth potential. And so they haven't been hit at all by this market downturn. They have stayed intact because they were principal protected. And that's why that's part of our diversification strategy, part of our process. So if anybody out there is still worried about what's going on right now, reach out to us. Get 15 minutes on our phone. We can discuss whether you're afraid of risk, whether now you don't think you have enough money to last your entire life, whether the tax thing that I mentioned, there might be a good time to convert to a Roth at this point when the market is down, because you'll pay less tax on those shares than what you would have if you would have converted, say, in January, because they're depressed a little bit, and that's not necessarily a bad thing if you know how to take advantage of it. So that being said, again, I hope that gives everybody a little bit of perspective on what's going on. Again, not so Pollyanna to think that there's not going to be a recession, but also not doom and gloom to think it's going to be horrible. So rewind this and listen to some of those statistics again if you want to help get just a little bit more reassurance that even though this might not be short-lived, I'd say, the 289 days, 9.5 months. So mid-October before things really maybe start to turn around. So we got a few months where we're still riding through the crap a little bit. Just understand that this too shall pass, and we will be back out again. The market will be back up and positive, and things are going to go great. And we're all going to forget about the bear market again until the next one happens. Right. So that's it, guys. Again, reach out. Our link to our calendar is going to be there. Get 15 minutes on the phone, and hopefully we can help you guys just get a little bit more reassurance as well, if you don't currently have it. Because if you got that feeling in the pit of the stomach from everything that's going on right now, maybe we can take that feeling away from you. And so by giving you good strategies to where the next time something like this happens, you don't have to worry about it. You're going to be fine. That's really our ultimate goal. That's what we want to have happen. And so that's it, guys. Pretty quick, but I hope that gives you a little bit of perspective. I mean, I wish I could just take my brain and just, put that inside all of your own brain when it comes to the market and the knowledge and stuff like that, just to help you realize that, this it's not the end of the world right now. You're going to be fine. It's going to be okay. So that's it, guys. Take care and be watching for another one of these episodes. We always want to continue bringing you content to empower you to live the retirement you deserve. Take care.